This is Ndtv. And you're watching Ndtv Hindu.
Welcome to Business Line. I'm Pranav Bakshi, and over the next half hour, we'll bring you all the business news and views that you need to know. Reliance Industries said it was making a cash offer for a majority stake in the bankrupt US petrochemical company LyondellBasell. Investors applauded this move by bidding up the shares. If Reliance gets a nod for this bid, with a combined revenue of $80 billion, it would outsize Dow Chemicals, the largest US chemical company.
It was like almost going back to the good old days of Dhirubhai, as investors flocked to buy shares of Reliance Industries, India's most valuable firm, which rose nearly 4% in intraday trading. After its weekend announcement of a non-binding bid for LyondellBasell, the world's third largest petrochemicals maker, that too in all cash. Market experts bet if RIL, a known beta of cheap and throwaway assets, will actually pay up, the projected value of LyondellBasell, that is around $12 billion, given that margins, both in refining and petrochemicals, are under pressure.
If you look at, I think, past 9 months data, then you find that at EBIT level, the LyondellBasell has been, I think, making some profits. But at net level, if you look at it, I think the net level the company has made still a loss of around $1.5 billion. So from that perspective, I think one will have to actually see what valuation one gets out, one pays out of Reliance's books to this company.
Margins, particularly in refining and petrochemical, are also very weak. So that's translating into low multiples on the mergers and acquisition side.
LyondellBasell gives ready access to technology and 9,000 exclusive patents, which Reliance can ride piggyback on, especially in the polyester segment. The combined entity, with an estimated top line of over $80 billion, also makes Reliance in one sweep bigger than even Dow Chemicals. But to take over or merge a company that's filed for bankruptcy has its own share of challenges.
And I believe in their statement yesterday they have said that the offer is contingent on the company emerging out of its Chapter 11 restructuring. We have to wait and see if its 25,000 odd creditors will be willing and to accept the restructuring and reorganization plan of the company.
Historically, Reliance's M&A track record has been poor. From Dow to Nova and even ICI, most of its efforts have bombed. Even its integration after buying DuPont's German arm Tavera has had problems. Will Reliance be third time lucky and finally break the perception that it's a giant only in its home turf? Watch this space as the story unfolds. Bureau Report, Ndtv Profit.
It's tough to keep Infosys out of the news. As American banks are once again looking at handing out huge offshoring contracts, India seems destined to remain a hot destination for outsourcing. But Infosys, one of India's top outsourcing vendors, is planning to improve and de-risk.
It's been a steady change of guard at India's most prolific IT major, Infosys. But what will the Infosys of the next decade look like under the new leadership? The company's executive council believes that diversifying its services portfolio is the way ahead. Infosys will adopt a bigger focus on opportunities around innovation, consulting, and knowledge-based services.
The huge opportunity that we have, not just around outsourcing, but around innovation, is what really excites me. This is an opportunity which sows the seed for the future business that you can develop in this part of the world.
So with outsourcing no longer the mainstay of the future, the focus is shifting to offering consulting services to clients in the healthcare, life sciences, retail, and energy segments.
We have 65% more bookings this year than last year on just new engagement models. We have almost 50% new billings this year already. This is going to become more a norm than an exception going forward.
But will this change in business model get the backing of the investor community?
Shareholders must always give it a thumbs up. True, there is some initial risk involved, but we have seen Infosys very successfully move on to coordinate. One is move up the value chain from businesses like outsourcing to consulting, and B, diversify its geographical markets.
While the diversification might help retain shareholder confidence, it will be tricky. This is also the time when the names and faces associated with Infy's glory are moving out of the company. The emphasis of the next decade, therefore, is looking at expanding business verticals and services and looking to shift out of the outsourcing model that has been its growth driver in the past. In New Delhi, Bianca Ghosh, Ndtv Profit.
If you're a mobile subscriber and always cringe when you see your mobile bill, it's happy days ahead for us. For mobile phone companies, though, the tariff war may spell doom.
Talk is cheap these days. Well, literally, at least for India's more than 400 million mobile users. Call rates have dropped substantially to 1 paise per second, and most companies have decided to usher in per second billing rather than the earlier norm of permanent billing, allowing users to pay for the exact duration of their talk time. While it was new entrants like Tata Docomo, MTS and ASL who started the tariff war, all telecom players have joined the race, forcing them to take a hit on margins. Industry tariffs fell from 50 to 55 paise per minute to almost 35 paise per minute. While the consumers are happy, analysts feel smaller players may not survive this tariff war.
The reorganization currently could happen anywhere from 18 to 24 months, subject to the regulation. And if the regulation changes, it could even be earlier, but I would not think it could happen anywhere earlier than 15 months.
Established telecom players like Bharti haven't done too well either. While its profit fell nearly 8% quarter on quarter, the average revenue per user is down a little over 9%. It's not Bharti alone. Even Reliance Communication and Idea reported subdued results. The tariff war has hit most operators so badly that across the telecom industry, average revenue per user fell 14% quarter on quarter. Revenues declined 3% and EBITDA, which reflects profit margins, was down 8% over last quarter.
So whether it is consolidation, whether it is capitulation, whether it is whatever shape it takes, you've got to get to, you can't have so many people just radiating and wasting money and with completely uncompetitive businesses.
As you know, 5 more new operators are aiming to launch. So in that sense, the current level of pricing is something which we have in the business plan. Our business plan is not affected by what we see now. But if the trend will continue, clearly we also can be hurt.
The bloodbath is expected to continue, so telecom players should gear up for lower revenues and profits over the next quarters, which promise to be one of the toughest periods for the mobile industry. In New Delhi with Saurabh Jaitley, Orijit Banerjee for NDTV Profit.
Let's now take a look at how the markets fared this week.
In a development that sent fresh shockwaves through the financial markets, Dubai World, a government-owned holding company which manages the country's portfolio of businesses, said it had asked creditors for an extension of 6 months on debt repayments of $59 billion. Stock markets, gold and commodities all fell in response to this announcement. The Sensex closed 2.2% lower for the week on this development at 16,632. Tata Steel reported disappointing consolidated numbers, declaring a consolidated net loss of 2,719 crores against a profit for the same period last year. The CBI arrested the acting chairman of the company law board on bribery charges. And JSW Energy has announced plans to raise 2,700 crores through an IPO scheduled to open on December 7th.
Time for a short break. Business Line will be back with investment advice shortly.